Hi all, I am Sham and I have Kishan with me.
Hi, Sham.
Welcome to Free Float. So today we are going to be discussing a sort of high octane strategy. It's momentum on steroids. It's called Momo. And before we jump into it, Kishan is going to give you a brief intro on on momentum and the overall setup for why it works.
Right. So, Sham, so the way I think momentum is like a wave. You know, uh, a wave is something that that can that can carry an entire can carry ships of all sizes through its currents. Especially when when the wave is pretty strong in its current. It's a factor which is very like persistent, and you can see this factor across across different things, and even in like nature. You see momentum in sports, through the hot hand where or even in general, if you think a player is performing well, it's likely that he will continue to perform well in the games. I'm following that one game. Because one good performance leads to more confidence, and then that confidence leads to better focus, better like enjoying the game. You feel more better about life. So it's a game also. Are more focused in it. And like even in a particular game, the hot and fallacy, which is now which was considered to be a fallacy, now it's considered to have some merit, where you can because you are playing very, very, very well, you're more likely to to score a basket, or to score a goal the next time round you try, because you're just in that zone. um, and it will also translate to your teammates and stuff, because they get also inspired by you, or at that moment it comes true. um, and you see it in business, like if one company is suddenly has had a good product and its sales are rising, then people within the company start are more driven, they're more like energetic, and then they're more pushed towards achieving better targets, and moving along in that way. I think a lot of success in life um, comes from when you to catch the momentum train, and then to ride it till as far as it can take you. So I don't think it's far in that far when it comes to investing, where the fact of momentum is based on belief that if something is going up, it will continue to go up, because it will drive more like investors into that stock, believing that something has turned around in the company. And you can come back to like maybe FOMO, or other things that might explain that, might explain it logically. But it's also a fact that when something is moving up is when more people start noticing it, and more people start like analyzing it, and try to make rational of why it's moving up. And it also dissuades people who don't believe in it. Like it makes people at least say, okay, I don't understand it, but I don't have to you know take part in it, or maybe I'll just give in. So I think there's a lot of that explains why momentum is uh, uh, such a common term today. It's become in the markets. Like it is easy to find. It doesn't take much calculations, and much of head breaking. Like almost anyone can do it. And it's a factor that most people have seen it to work. It's like it's like a diet fad, where more, if people start talking about a particular diet at the point, more people come on to it, and see if it works, and then more people start talking about it as well. So it's something like that.
Yeah, so it kind of leads back to Soros's reflexivity, right? So, you have your spiral ups and spiral downs, and each of them are kind of reinforcing. So, the minute a company has some momentum behind it, you will see that a lot of the bear thesis sort of kind of fades away. The naysayers either keep quiet, or they're watching on the sidelines, and also the funding costs come down as well. So it's not exactly that it's all sentiment, but there's a financial incentive for CEOs to make sure that they're telling a good story, and that their company stock is perceived in a good light, and so on. So you could be, like a grade A operator. You could be, focused fully on return on capital and yada, yada, yada. But at the end of the day, if you're not putting your company forward, in a good light and telling a good story around it, then chances are that, you know, um, like you're not going to get the full benefit of all your hard work. So it's not enough to perform. It is also important to tell a good story. And we see this again and again in the markets as well. So momentum is something that everybody can spot, right? A stock that is going up stands out. But at the same time, the reason why momentum continues to work is because most of the novice investors, they don't realize that anything that shoots up like a rocket can also explode like one. And momentum stocks have this humongous left tails, right? Where like portfolios can go up 100% in a year, and in the next year they can give up almost all of its gains and even more, as momentum stocks reverse, and yeah, or there's some sort of a external event and so on. So the biggest challenge with momentum investing has always been risk management. In making sure that you're not caught out on these left tail events. And risk management also implies incurring a fair amount of transaction costs, because no matter how you skin it, whether you employ stop losses or trend following or hedging, they all involve costs, upfront costs and also opportunity costs. So there's no escaping that. And most novice investors, if they have like $100 to invest, they'll put all of that $100 into momentum, saying that hey, past performance is awesome, let's go for it. And they don't have much left for the risk management aspect of it. So so they end up giving up on momentum at these turning points, and they're never in it for the long haul. So in the long term, momentum outperforms, but in the short term, it's likely to break your heart. So that's always been the problem with momentum. And the second problem is that most of these novice investors, um, they read the literature, right? And it's easy because the literature says rebalance once a month, right? But what they don't understand is that literature was written 30 years ago, and sometimes even more. So back in those days, you did not have the kind of compute power, you did not have access to market data that we have today, right? So those researchers took some shortcuts. So they used monthly returns because that was what was readily available, and they could put it into a manual spreadsheet, like literally a paper sheet with cells on it, so that they can analyze it. So it was very difficult to do this sort of computational analysis back in the day. So they said, okay, let's take a monthly return series and analyze that. But the problem is that if you do that, you live in a world where data is abundant, right? You have market APIs all over the place, and they're cheap. And so that allows other people to sample the market more frequently than 1 month. And second thing is, transaction costs were a real problem back in the day. So even in the US, right, they had a system of negotiated brokerage, and at the retail level, sometimes it could go as high as 5%, right? And in India, I'm still, old enough to remember that at some point it was 2.5%, right? Yeah. So there were guys who were charging 2.5% brokerage in Bangalore. So
you can get rich. Seriously rich.
Yeah. So talking about market data, right? So here's a tidbit. Before NSE kind of completely won the battle, a seat on the BSC stock exchange, right? So it was hard to come by. So it was so valuable that BSC brokers would only leave it when they were on their deathbed, literally, right? It was so lucrative to have a seat on the BSC stock exchange. So they would auction those seats out, and they were rare. And they would, in the 90s, people would pay like 5 crores and all to get a seat on that BSC stock exchange. And the reason is information flow, right? If there was any corporate action or any notification, some peon would come, the brokers would grab it, read what it is, and the peon would go and stick it on the notice board. That was the state, in which corporate actions were announced, right? So obviously that seat gave you, the first dibs on any market action that was possible. But we don't live in that era anymore, right? So we have the same kind of access to information that anybody else has, and that's why you've seen a collapse in in all these old school way of doing things, right? So Zerodha brokerage is zero.
Yeah.
So you're seeing this massive compression in costs, which was not true when all these strategies were first researched and published. So what has happened is, when you try to use the same strategy without adapting it to the current scenario, you're going to have like seriously subpar performance in your portfolios. So how do you overcome all this, right? It is through automation. It's like not humanly possible to run risk management, stock selection, ranking, all that stuff day in and day out, without fail, and getting it executed at a decent rate is just not humanly possible to do that, like in the old school way of doing things. So you have to automate the whole pipeline, and that's what Momo strategies are, right? It's just machine driven momentum. And the beauty of these machine driven momentum strategies is that it frees you up to sort of strategize and think about stuff from a top down level, rather than spend all your time computing statistics and executing trades. And that allows you to further refine this, and make sure that your risk management systems are up to speed. You're not buying certain stocks, you're not doing certain things that increases friction. So the reason why we are discussing Momo today is that I have personally seen a lot of investors say, "Hey, momentum, what's the big deal in that?" Right? Or say that, "Oh no, I'm a value investor, or I only invest in quality companies." Now, the problem here is that, and we've discussed this in the past, retail investors are blessed in today's day and age. They, number one thing is they have complete flexibility to follow any investment strategy that they want. And nobody's holding a gun over their head saying you should buy only quality stocks, only Nestle, only ITC, right? So given the situation, why do they have to bucket themselves into one specific strategy? It makes no sense. And all this buy and hold stuff, and we've repeatedly mentioned this, only works for US, and that to S&P 500, right? Every other country other than US have seen massive drawdowns that take like 10 years, 20 years, for them to dig out of. And most of your investing life, if you're doing this for retirement or goal oriented stuff, is maximum 10 years. So while in a 30-year time frame, even US stocks buy and hold have not shown any losses. Very few people have 100% of their portfolio with a 30-year time horizon. That I've never come across that. So you have to be sort of pragmatic, in the way you think about your own portfolio, especially at the retail level, and stop playing the same game with the same rules that is meant for people who manage 100 crore and above portfolios, right? There's no reason why you should enter a boxing match with one hand tied behind your back.
Yeah,
right?
when you're not Muhammad Ali.
Yeah, exactly. So that's 100% true. And also the problem is you're not managing a 100 crore portfolio, right? You're managing your small kitty that is that makes an impact to you, right? And it's only boss. Whereas professional investors are playing a different game. And I hope the analogy I gave in the post, which is the difference between a Ferrari and a bus, right? A Ferrari is meant for the driver's pleasure. So maybe one girlfriend on your side, or boyfriend on your side, right? It's not it's not meant it's not meant to take your family for a picnic. It's not meant to drive your kid to school. And similarly, a bus can carry 100 people, right? But it's not going to go 0 to 60 in 3 seconds, right?
Yeah.
There are two completely different use cases. And professionally managed portfolios are like the bus. So a mutual fund has 200 stocks. It has their goal is to cross 1,000 crores in AUM. You ask any mutual fund manager, they have this dream that their fund has to cross 1,000 crores in AUM. So they have all these massive portfolios. So they're driving a bus. So when you drive a bus, the first thing is, you need to be certified. Not anybody can, just become a bus driver, right? So you have your certifications, you have your safety checks, all those things are there. And, those things are governed by mandates. And we spoke about this as well. Whereas, a Ferrari is meant for is meant for you, right? And it's meant to go fast. So, and it's like the Maruti car ad, right? Kitni deti hai, right? So how much does it give? So the guy buying a Ferrari doesn't care how much mileage it gives, right? He just wants to go fast. So there's a way in which you engineer systems, based on their ultimate use case and the customer profile you have in mind. And Momos are like the Ferraris of the investment world.
Right.
So it's meant to go fast, and it's not meant to carry 30 people. It's not going to scale, to like 100 crores or 1,000 crores or whatever. But it is meant to go fast, and it's meant to be very quick. And the thing about this is it's a systematic way of approaching the markets, and systematic ways scale across markets. So we've been running this, on Indian stocks and US stocks. So, if you want to kind of diversify your risk and also scale your portfolio, you can have like an Indian bucket and a US bucket, right? Each running Momo. So you get like the benefits of of diversification across geographies, and you're still running the same algo, so you know what kind of drawdowns and and what to expect out of it. So we've given links and historical performance and all that. So I just wanted to kind of bring out the difference between a Momo and say the old-fashioned buy and hold sort of investing. And I hope I did that. So this is definitely not a buy and hold gig. Sometimes stocks churn out within a day, right? So you buy something, it doesn't work out, it gets sold the next day. So it's there's no sort of stickiness to what goes on under the hood. So and this is typically meant for people uh, who are looking for something different from what is being offered by the large scale manufacturers, mutual funds. So I hope that the difference is clear, and it's up to you to kind of evaluate your own temperament to see if this sort of investing. Yeah. But the returns are kind of it beats whatever benchmark you throw at it. And and it performs well even during crisis, the way it is because the risk management system is sort of tightly coupled to the to the strategy itself. So so you have the benefit of not of avoiding steep drawdowns, and that allows you to sort of stick with the strategy over a long enough period of time. So so this is kind of like a well-oiled, engineered system. It may not be for everyone, but it's for the same reason why not everybody buys a Ferrari, right? So, yeah. So you have any questions, or do you have any experience running these sort of systems, Krish?
Yeah, actually, I've been running momentum strategies for like 6-7 years,
Right.
and all different kinds of momentum strategies. Like from like a particular universe to running it with filters, to improve the kind of picks you get, to maybe having like momentums in like different stages, with like different like look back periods, and like trying to also trying to have a stop loss so that you limit your risk in the sense drawdown and stuff. Also, trying to shift between equity and debt, doing tremendous, so that you can, not have that drawdown as much. So, done many things over the past, and, each of them has the same drawback. They do very well in the good times, except for the ones which have some kind of a very high quality filter of like a specific universe. They all have drawdowns, which are pretty sharp.
So you mentioned switching to debt. So in fact, for US stocks, we have this thing called the global equities momentum and the factor rotation momentum. So
Yes.
I linked it at the bottom of the post as a PS, as a postscript.
Yeah.
So that actually does that. So it looks at how different markets have performed over a look back period, and if equities have basically been trashed because of some macro event, it switches over to US treasuries, right? So so it has the ability to sort of wait out the market volatility and then get back in the game once things stabilize. So in my experience, the thing is, it doesn't work all the time, right? If it is a shallow drawdown, 5 to 10%, then you just spend your brokerage and your thing on the churn, right? Your portfolio is going to draw down 5 to 10%. But the benefits really kick in during severe shocks, right? For example, the COVID shock or the taper tantrum, or whatever. So whenever there's like a severe shock, it has the ability to kind of go into cash and wait for the market to recover. So I think and the other thing is, I see that these sort of crashes happen every 3 years. So it's something or the other, right? So there's some war, some drone attack, some nonsense. So it keeps happening once every 3 years. So it adds up. So your crisis alpha sort of adds up over a period of time. So it's definitely something that people should consider. We have it running for both US and Indian stocks. There are different flavors of it. We've linked all of that on the post. It's best that you kind of have a look at it, do the pros and cons, and and get back to us if you're interested. So with that plug, I think we'll wind up today's free float. I hope you guys enjoy the post, and if you have any questions, do let us know.
Thank you.